Hello traders, Gary Wagner here at just about 12 noon in Honolulu, 6 o'clock in New York. It is Tuesday, July 28th, 2020, and this is the daily report for gold and silver. A nice climb in gold today, but during the day we saw a $75 range with a low of $1,900 and a high of $1,975. That's the first time we've seen large wicks or tails, meaning a differential between the open and the low and the close and the high in quite some time. That prompted us to raise our stops, and we did pull profits on our trade. We will talk about that in detail when we pull up our technical studies. But first, to the price board. Today, traders and market participants continued to witness the dramatic rise of gold, gaining approximately $20 on the day. We are looking at the continuous contract. This is still basis the August contract at $1,950.60. That is a new all-time record high. The one noteworthy aspect of market action today was the tremendous range from high to low. As you can see, that the market actually touched briefly upon $1,900. That did affect us in that we pulled profits on our trade that we put on Sunday. We'll talk about that in detail when we pull up our technical studies. But as you can see, we traded from a low of $1,900 to a high of $1,974, approximately a $75 range in gold in a single day. Quite a move. When we look at spot pricing, spot is currently trading up $16.26 at $19.58. October gold is at $1960.80, and December gold is very, very close to striking distance of 2000 at $1971.50. Silver scored a modest gain today, approximately 2.5 cents at $24.52.5. Palladium did lose a little bit of ground, $23.64. Platinum gained about 2.3% at $9.89. And the ETFs that we have been trading and following, GLD gained $1.52 a share, while silver had a slight decline, $22.77 per share, and Nugget lost about 1.18% on the day, currently tracked at 109.29. Traders, let's take a look at our technical studies. The first thing that I do want to talk about is our current trade and the fact that we pulled a small profit on that trade yesterday. The rationale behind that is that as we make money moving forward, I'm expecting to have quite volatile swings and volatile days. There are two components to an effective trader. The first component is to effectively predict where the market is going to go and to be able to profit from that. And then the second thing that we must accomplish is capital preservation, so that when I believe that we could see some erratic swings in the market, I certainly do not want to get us stopped out at a loss. So we did send out a special trade alert, effectively raising our stop to 1938. We entered the market at 1924 and pulled a $14 profit, or $1,400 per COMEX contract. When we look at the range, we had a low, as we said, on our opening price board of 1900. We had a high right around 1975. So that is a pretty tremendous swing in terms of a daily range. The other thing is that when we compare them to recent candles, we have seen this consistency of green candles, simply meaning that they closed above the opening price, but they've also been defined by fairly short wicks or tails, and that is the distance between either the close and the high or the open and the low in the case of a green candle. So when I saw this market start trading under pressure yesterday, the dollar firming up just a little bit, my sense was that it is better to be safe, to pull a profit, and even if we have to buy the breakout and buy higher than we exited the trade, we are still able to pull a profit, and at the same time, we are continuing to hold our nugget, our SLV, and our GLD. Which brings us to our studies and current market forecast for gold. As you know, I use a combination of fundamental analysis and technical studies to determine where we believe gold pricing will head. In the case of using technical indicators when we're at all-time record highs, it becomes difficult at best because the market technician relies on historical data to see how a particular stock or commodity reacted at a certain price point, historically speaking. When we are at all-time record highs, we simply do not have that tool available. One of the most reliable tools that is available to us as a market technician is a combination of Elliott Wave and Fibonacci extension. What we are doing is we are looking to forecast a fifth or final wave in a 5-wave sequence by measuring the distance or range that gold moved between the end of the second or corrective wave and the longest of the impulse waves, wave number 3. When we do that and do our measurement, we then begin our extension from the conclusion of the correction, which in this case is a wave 4 correction, and then we attempt to forecast where the market could go. One of the primary 3 rules or laws of Elliott wave forecasting or creating an accurate wave count is that wave 3 cannot be the shortest of any of the impulse waves, which means that wave 5 can be equal or slightly shorter than in terms of range than wave 3, but not larger. And that's why we are looking at our forecast right now at approximately 2100, and that is looking at the potential for a 1-to-1 relationship between wave 3 and wave 5. Therefore, traders, it is my belief that there is more upside potential in gold. I believe that gold could easily move another $100 to $150 before the end of this rally. And based upon that, we will look to reposition ourselves from the long side in gold futures as well as gold forex. For in the meantime, we will maintain our rebalanced portfolio, which is heavily weighing SLV, GLD, and NUGT, and look to reinitiate a long position in gold futures and Forex Gold. This has been Gary Wagner, wishing you as always good trading. We will talk to you tomorrow for the next daily update and review. Bye-bye.